From New York City for our audience worldwide, Bloomberg Real Yield starts right now. Coming up, inflation pressures lingering into year-end, posing a dilemma for a patient Chair Powell as volatility returns to the bond market. We begin with the big issue, kicking off Q4.
We're still dealing with a lot of uncertainty.
From Q3 to Q4.
It's going to be ringing alarm bells.
The supply chain issues.
Even though demand is there.
The real question will be on the supply side.
This is foregone profit.
For those inflationary pressures.
Inflation isn't going down.
The Fed has said that they're changing policy.
Inflation is above the Fed's target rate.
It's very unlikely they can get to that target.
The Federal Reserve.
No one wants the Fed slamming on the brakes.
So the story's the same.
The markets and investors are climbing a wall of worry again.
We don't know exactly how it will be worked out.
The real question is, what do you do as an investor?
To help us navigate 4Q, SocGen's Subadra Rajappa, Morgan Stanley's Matt Hornbach, and Collin Martin of Charles Schwab. Subadra, let's start with you. The playbook for Q4 with you, Subadra, what is it right now?
Well, I think that those concerns that you highlighted earlier on in the program is definitely valid, right? You are seeing, pretty positive data. We got very strong ISM. We got a very strong consumer. The Delta variant cases seem to be coming down. But really, the concern going forward is going to be much more focused on inflation, supply chain constraints, and whether we'll be able to get workers back into the workforce in the fourth quarter so that the Fed can on schedule, announce a taper announcement at the November FOMC meeting.
We've all heard the same concerns. The concerns about inflation, the concerns about growth. Deutsche Bank summed it up as follows. Gangbusters ain't happening, stagflation instead. We'll pick up on that word in just a moment. Here's the quote. It all boils down to accelerating negative supply-side dynamics defined by two key features, an upgrade to inflation and a downgrade to growth expectations, both at the same time. Matt Hornbach, I want your thoughts on this quote. Upside risk to inflation, downside risk to growth. Can you walk me through what that means for this bond market?
Yeah, thanks for having me on the program, John. I think it's really more about where expectations for growth are going to be heading. I think we've already had the slowdown in growth, it seems, and really we need data that give people a better perspective or a more optimistic perspective on 2022. So for us, you can have both sustained high inflationary pressures as well as a rebound in growth expectations. Eventually, the data will follow, we think. So ultimately, we think both of these factors will press bond yields higher into the end of the year.
Collin, do you agree?
We do agree. When you look at economic growth and expectations, it's been our view that we've probably hit peak growth, but it's not like we're decelerating and going to go back down to zero. Growth readings are still very strong. We saw strong ISM manufacturing this morning. And when you couple that with inflation pressures that are higher than a lot of people expected, certainly what the FOMC expected, that should all lead to higher yields through the end of this year. So that's part of our playbook. We think the 10-year Treasury yield should continue to rise from here, mainly because we still have accommodative and easy monetary policies. I think that's the concern going forward. What does inflation do to the Fed stance? But for now, financial conditions remain very, very easy, allowing growth and inflation expectations to rise.
That word stagflation has been thrown around so many times this week and through much of this year as well. As you point out, Collin, and Matt to a certain extent, looking ahead to next year, we're looking at real GDP growth potentially with a four handle. Subadra, I don't know about you, but that doesn't sound like stag in stagflation. When people use that word around you, Subadra, what do you say back to them?
I completely agree with you. I just don't think that it's stagflation to me means a stagnant economy. The economy is still growing at a pretty good clip. And if anything, I think this year's growth is getting pushed forward to next year. So yes, we're going to be revising down this year's numbers, but we're also kind of revising up next year's numbers. So really what the unknown is, if you will, is how much, if there is a persistence of inflation, how much will it eat into consumer spending? Will it eat into the growth prospects and the trajectory for next year? And that, I think, is the key risk. And I think that the Fed, in its policy, has to be prepared to be able to raise rates soon if there is a clear sign that inflation remains persistent well into next year. And that, again, I think is going to impact growth adversely. So those are the things that we're watching on our end.
Will it overwhelm the Fed's goal? This is a really, really important conversation. The inflation story is persisting into next year. Will that overwhelm the Fed's output goals, employment goals? Take a listen to what Mohamed El-Erian had to say on that.
Inflation isn't going down. Inflation is hot at the core level. And you know what? If you do the pure statistical calculation, it's very unlikely they can get to that target. So they're going to be revising their end-year target up yet again, and they're going to be signaling to the market yet again that they don't understand the inflation dynamics. So this is consequential. And the risk is, John, that at some point, the market challenges them. The market will not challenge them with purchases of 120 billion, but the minute those are lower, people will have the courage again to short the bond market.
I'd like you all to respond to that. Matt Hornbach, first to you, your reaction.
Well, John, I think, investors will challenge the Fed when they feel it's most appropriate to do it. I don't think that bond purchases are standing in the way of that. And we can just simply point to what happened in 2013 when the Fed was still buying bonds. The market had no problem throwing a taper tantrum. So I think it's less about the Fed buying bonds. The market just has to feel comfortable that it's doing the right thing. Investors have gotten burned way too many times being short duration. So it's more about a comfort level and a confidence level that growth is really going to pick up and inflation will remain high.
Collin Martin.
Well, I think it does put the Fed in a very difficult position and situation. It was just over a year ago that they changed their policy to allow inflation to run a little hot. And I don't think they were expecting 5% readings this late or just 12 months later, which potentially could be on a sustained basis. So they've kind of boxed themselves in a little bit. I agree with Matt, where I don't think the tapering should have much of an impact there. It's been well communicated. For us, we think the risk would be if the Fed were to tighten faster than the markets are pricing that in, just because of those high inflationary numbers and a lot of concerns out there in the market, what that does to growth and inflation expectations. We think that would limit any upside in long-term Treasury yields and maybe pull them lower if they were to preemptively tighten and kind of choke off the recovery.
Subadra, you heard Mohamed's comments. Your response?
I think I agree with the other speakers. I think for the most part, the concern is not so much on the tapering side for me because of the fact that, even with the current sort of expectation for tapering, the Fed's going to be buying about $600 billion when they're done with their asset purchase program. So that's almost the equivalent of how much treasuries they bought in QE2. So I don't know if it's going to be the taper, but it's really the repricing of hikes that I think is going to be quite consequential. Just over the last week, we've seen a significant pressure on the 10-year and the 5-year part of the curve as the market started to reprice in a much more aggressive pace of rate hikes. I'm not saying that it should get any more aggressive from what we've already priced in right now, but that is the risk, is that we do see a sell-off led by the belly if the market starts to price in a much more aggressive pace of rate hikes.
And hiking potentially into weakness. And that's what I want to touch on really, Matt. There's been this big conversation this week, much more so about this EM-type dilemma gripping DM central banks. A little bit more so for the UK, maybe a little bit for the Federal Reserve at some point next year. I've got no idea if that's what transpires. I'm looking at the estimates. I see 4% GDP growth for next year. The ISM this morning was okay. It was pretty decent still, Matt. Can you just give me your comments on that? This idea that this EM-type dilemma grips DM central banks through the next 12 months.
Well, John, I think this really speaks to the topic you raised earlier on the program, which is stagflation. Stagflation ultimately is about when supply and demand are both falling, but supply is falling faster than demand. That's what ends up leading to weakness in growth as well as higher inflation rates. And in the US, for example, John, we have a little example of that in the services sector. Last year we had a decline in service sector demand, but we had a larger decline in service sector supply, which is why even with both of those things happening, service sector prices went up. So, I think the future for the global economy doesn't really involve demand going down. We think demand will be going up, and that is really hard to call that a stagflationary environment. So these equivalencies between what's going on in the UK and what is happening in emerging markets, I just think don't really make sense to me.
Collin Martin, your thoughts?
I agree there. And John, we've seen your comments on Twitter this morning about stagflation. I agree there. I mean, if we're seeing growth of 6% or 6% area this year and 4% next year, it's tough to see how that could be described as stagflation. Now, one thing that we'd be concerned about is the signaling. So even though growth is strong in an absolute sense, albeit maybe decelerating a bit next year, it's the signaling of what tighter financial conditions could mean. Where if you look at where rates are today and they were to hike 25, 50 basis points, that really shouldn't have much of an impact, but it's a signaling of what does that mean going forward, where we saw that in 2018, just the hint of the Fed continuing to tighten when the markets thought they were already tight enough, sent the stock market tanking and tightened financial conditions. That's what we're looking at. The absolute rate is low. Growth is still strong. It should be able to handle it. But our concern is that the markets aren't necessarily priced for that right now.
We're going to build on that next, Collin. Collin Martin, Subadra, Rajappa, Matt Hornbach sticking with us. Up next, the auction block. Junk bonds closing out the month with the busiest day in 7 years. That conversation up next from New York. This is Bloomberg. Live from New York City, this is Bloomberg Real Yield. It's time now for the auction block where we kick things off over in Europe. Weekly sales topping 24 billion euros, pushing monthly issuance above 200 billion for the first time since January. In the US, high-grade borrowers plowing through the volatility, a deal from Analog Devices pushing weekly sales up to 23 billion. And the junk bond market raising another 16 billion this week, closing out September with the busiest day in 7 years. Still with us, Subadra, Rajappa, Matt Hornbach, Collin Martin. Collin, just give me a flavour of the primary market and what it tells you right now in credit.
Well, the primary market continues to run hot. You have tons of demand from investors looking for anything with slightly higher yields than what they can get in the safe Treasury markets. And on the corporate side, you have still historically low borrowing costs. And a lot of what we're seeing is really just kind of liability management, issuing debt to clean up their balance sheets, tender offers to take out higher coupon rates. So you have that perfect marriage of strong demand and companies still shoring up their balance sheets because rates are so low. So that can continue, and corporations might continue to try to hit the primary markets, given all the concerns that rates can continue to rise in this final quarter of the year.
We've had some volatility, but it is not December 2018. It is not 2013 either for some people. Subadra, can you say we've even had much of a tantrum in this bond market yet?
Not really. I mean, we did see a little bit of a tantrum earlier on this year when yields rose quite dramatically. Again, after we sort of got very, very close to 175, we've kind of dialed back our expectations for yields as well as for growth in general. There is, of course, like Mohammed pointed out earlier, there's a chance for a tantrum if this risk of inflation starts to get out of hand. But broadly speaking, I think the expectation is for a steady improvement in the fundamentals and for a gradual rise in yields. And that sort of environment, I think, is good for credit as well as for risky assets.
What surprised some people has been this move through the FX market. Matt Hornbach, if you can put on your FX cap just for a moment, what's been happening, Matt? And why all of a sudden have we started to see this big push through the FX market, some real dollar strength?
Yeah, John, I think actually there is a tie-in here to the commodity story and this inflation narrative that you're talking about in the program. We've had natural gas prices in Europe going up quite dramatically. That has been raising break-even inflation rates in the UK as well as in Europe more broadly. And with the dovish central bank in Europe, with the ECB, and the Bank of England, perhaps not quite as dovish, but generally speaking, still on the dovish side, that has allowed real interest rates in Europe to remain extraordinarily low. Contrast that with what's going on in the US, with real interest rates having risen. You're seeing this decoupling that we've been expecting between real interest rates in the US and those in Europe. And therefore, the investment environment in the US just looks more attractive from an interest rate and growth perspective. So ultimately, those factors do raise, the attractiveness of the US dollar as a currency with which to ultimately put your money to work in. And that's why we think the dollar has been appreciating of late.
That raises some questions, Matt, about how self-limiting any move to the upside would be on 10-year yields in this market, just in terms of foreign participation in treasuries. Matt, your thoughts on that currently?
Well, John, I think all year we've been expecting interest rates to rise in a gradual fashion. And, I would describe what happened earlier this year in many ways is irrational exuberance rather than a taper tantrum of sorts, because people just, I think, forgot about the fact that the liquidity dynamic this year was going to be so powerful that ultimately that liquidity would find its way into risk-free assets, just as it would find its way into risky assets. So ultimately, we do think that yields will move higher, but in a gradual fashion. That's frustrating for a lot of investors these days, John.
It's frustrating for many people through the year. I mean, how long have we spent much of this year saying they shouldn't be down here, yields shouldn't be down here? Subadra, a question, I guess, for you, and I've asked it repeatedly through the year, just how self-limiting a Treasury sell-off market sell-off would be. How self-limiting would a Treasury market sell-off be?
I agree with Matt. I think there's just a lot of cash ultimately to put to work. I mean, even in this sort of move we've seen in the last couple of weeks, you're going to see some foreign investors say, hey, you know what, maybe we wait to see where 10-year yields settle down. And let's say 10-year yields settle down between 150 and 170, and that's the new range. You're going to start seeing foreign investors come in and buy treasuries on a currency-adjusted basis because of the fact that yields continue to remain attractive relative to where yields are in Europe and in Japan and other countries where both real yields as well as nominal yields are very, very low. So that sort of dynamic, I think, is here to stay. We've seen tremendous demand for treasuries from even domestic investors at the auctions, given the fact that there's just a lot of cash to put to work. And so we know that there's around 1.4 trillion sitting in the overnight RRP. The savings rates in the US are high, so cash has to make its way into all markets.
Subadra, when people think about the limits of the 10-year Treasury yield, they might reflect on what happened in late March, in and around 180. What's the biggest difference for you between now and then? The sell-off in Q1 and the sell-off in the back end of Q3?
The sell-off in Q1 was much more, I would say, based on the trajectory for growth. There was a lot of optimism right after the announcement of the vaccine. And I think that now, we've had sort of a reality check, if you will, on the vaccine front, given the fact that there's all these variants. And we know that going forward, the progress is going to be much more gradual and it's going to be in fits and starts. So I think that the market's sort of adjusting its expectations based on that. And there's also, like we were saying earlier, there's a lot of cash. So again, that I think is going to be somewhat limiting in how high yields can go. So from here on, I think the rise in yields is going to be gradual unless there's something that happens on the inflation front that causes a little bit of a panic in the market and we see a little bit of a tantrum on the back of that.
Collin Martin, final word on this.
Yeah, if you look back to the first quarter of this year, it was more due to peak growth and inflation expectations. And now here we are now in the fourth quarter. It's likely that we're past peak growth, but I think the jury's still out on peak inflation. So I think that's going to be a key driver through the end of this year and into 2022, not just what actual inflation is, but expectations as well. One point, though, I kind of want to take the other side of the discussion that the other two guests had about self-limiting treasury yields and the international bond markets. We think that international yields could actually help our yields rise a little bit. I mean, we agree that the 10-year treasury yield or any treasury yield should be tethered to what global bond yields are to a degree, but we are seeing more inflation overseas. We're seeing some central banks that are maybe not quite hawkish yet, but a little bit less dovish. So if we see, global yields rise a little bit, a rising tide lifts all boats. That can help lift U.S. yields also. Well,
EM central banks are certainly turning hawkish, that's for sure. Brazil, thinking Brazil, not so much Turkey, but Mexico in the mix as well. Collin Martin, Subadra Rajappa, Matthew Hornbach sticking with us. Still ahead, the final spread, the week ahead, featuring more Fed speak and a payrolls report. From New York, this is Bloomberg. Live from New York City, this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, another busy slate of Fed speak. A ton of them. Williams, Metzler, George Bullard, all on the calendar, plus plenty of economic data with ISM services on Tuesday. Initial jobless claims on Thursday, and we close out the week with the main event. It's the payrolls report on Friday. Some final thoughts with Subadra, Rajappa, Matt Hornbach and Collin Martin. Matt Hornbach, just to you, sir, quickly. The average estimate, the median estimate, 488k in that payrolls report. The range is only 500k this time around. What are you looking for on Friday, Matt?
Well, we're looking for something that's close to the median estimate, John. I mean, at the end of the day, the payroll reports have been coming out all over the map. And so we just have to wait to see what it shows us. But I would also just highlight, it's not just about the headline payroll number, John. There's so many details in these reports. And there's never or very rarely a clean read just by looking at the headline payroll number. So we have to pay attention.
What are you focused on, Subadra?
Earnings. I mean, if you look at average hourly earnings, I mean, I think that the expectation is that it's going to be another 0.4. With all this focus on inflation, I think I'd be concerned about sort of the narrative around labor shortages. We know that there's about 10.1 million job openings and only about maybe 6 or 7 million unemployed. I'm sure this report's going to have a lot of distortions because people are coming back into the workforce after the unemployment benefits are expiring. So the headline number might not be that important as all of the details of all of the other subcomponents.
Yep. Should we get to the rapid fire round? We can do this really, really quickly. 3 quick questions. What first, 1% or 2% on 10s? This is my go-to question at the moment. 150 right now. What first, 1% or 2? Subadra.
2%.
Matt.
2%, John.
Collin.
2%.
Chairman Powell's a dangerous man. Does he get a second term? Subadra.
Yes.
Collin.
Yes.
Matt.
Yes.
Just for the record, I don't think he's a dangerous man. I'm not telling you even if I did. That's just Senator Warren, okay? Subadra, Rajappa, Matt Hornbach, Collin Martin. Guys, thank you. Enjoy your weekend. From New York City, that does it for us. I'll see you next time. Same time, same place. This was Bloomberg Real Yield. This is Bloomberg TV.